wonderful to be here with you again, RJ. There's a lot to talk about as we had some great conversations ahead of this. And I think that as we look ahead to 24, I think that the number and the data behind 23 was truly unbelievable. And I think Placer really helped many of us on the competitive landscape really understand this better, RJ. And I think that, so many of the conversations that we're in, the data is being utilized to help retailers, brands, REITs really understand some of the dynamics that, of course, are always a little bit different than what we all believe. So with that, I want to turn it over to you because we have a lot to get through in a short period of time.
Yep, no, absolutely. We'll go through this quick, and thank you both, Stephen and Deborah, for the introduction. Stephen, you already covered the agenda, so let's just go into quickly for those who aren't familiar with Placer. And Deborah, as you pointed out, we are finding new use cases for our data every single day. Every hour, I'm coming up with something new, either with our team internally, our analyst team, either with our customers, our prospects. Every day we seem to find something new and a new way to leverage geolocation data. For those of you who are not familiar with Placer.ai and how the platform works, we're a location-based analytics company powered by mobile data. In simpler terms, that means we can come up with foot traffic estimates for any physical property in the United States, or really anything you can draw a map around or shape around on a map, whether that's an individual retail store, shopping mall, restaurant, airport, downtown district, anything you can draw a shape around, we can come up with estimates. Well, how does that work? Well, we partner with several dozen app companies, and through those app partnerships, we are given 24/7 location data for a panel of about 25 million devices at this point. Importantly, we don't collect any personal information. All the data we collect is anonymized, aggregated. There's nothing we know about the device user. And really from that panel that we collect, that anonymized data, our data scientists are able to come up with algorithms using the latest in AI machine learning that we can extrapolate that sample size, that 25 million devices going into different locations, and then extrapolate that for the location in full. At this point, we work with over 3,000 customers, many of the largest retailers, restaurants, commercial real estate companies in the world. We test that data, and when we test the data, it's generally in the 95% accuracy data. And to Deborah, your point, sometimes it's amazing what you find. And everyone's kind of some of the stuff you think maybe it's directionally there, but there's always new insights that come from that. But importantly, we're much more than just a foot traffic company at this point too. And on the next slide, Stephen, there's a lot more uses for this too. One of the more interesting things is, again, I mentioned we don't collect any personal information, but what we do is partner with a lot of other data sets. So if we know a device goes back to a certain zip code block every night, we can infer that is probably the home location. We can then put a composite together of all those zip code blocks and come up with a persona who may be coming into your stores or who may be visiting a certain travel destination, things like that. A lot of market share, visit frequency, demographic studies, a lot of different ways you can use the platform. And if you haven't checked it out for yourself, please come over to Placer.ai. We want to see you, want to talk to you, find ways to engage with you. And so that's kind of the Placer platform. But obviously, what our data, what me as an analyst, what the analyst community in general loves to look, we like to look at this at the category level. And so I thought, let's start with a look back at 23 here, Deborah.
I mean, I think as we look back, at last year, I do think that there had been a narrative around, right, a consumer who was, right, I mean, it's funny, it's like, kind of Groundhog Day, really. I mean, it's like we're having the same conversations again around recession. I'm at the point, I think CNBC just needs something to talk about because it's, we were very much of the opinion because of a lot of what we saw in employment data and, kind of truly, the way that, and honestly, a lot of it was through our partnership with Placer, a lot of where people were spending and how they were spending. So I think going back, there had been this belief that the consumer was only going to be value focused, that it was all value for money, that, they were going to focus on needs versus wants. But I think this tells us a very different story.
Yeah, it does. I think, if you rewind about this time last year, exactly right. Everybody was worried about recession. There was a lot of discussion about value and trade down and trade out. But what we saw is a little bit different story than that. And, there's a couple things on here that kind of point to that. Beauty and self-care. I mean, this is certainly a derivative on kind of the great reopening and people wanting to be out more and more. But what you see there too is it was a little bit more driven by a lot of other factors too. It was, kind of a younger and a lot of times less affluent audience. The whole category did well, and certainly there was the idea that people were being out more, but I think it also showed that, that there was some discretionary spending still out there. A lot of the younger population continue to visit beauty. And the category itself did great, but I also want to point out there was a lot of company specific things. Ulta did a great job diversifying the brands and the lines that are brought into the group. And as a result, our demographic data showed that they all of a sudden had a much more diverse, much younger audience come in. So I think that was kind of one of the other stories. Now, obviously, we on the rest of the slide, we show some of the dollar and more value focused categories, but I don't think that tells the whole story either. I think, what we saw was that, particularly around events. So if we think back to, first half of last year, Valentine's Day, Mother's Day, events like that, consumers really did spend. It was the shoulder periods that a little bit weaker. But I think we kind of go back to last year, I think we underestimated that people still were willing to spend around these events. Certainly, there were value focus, and I think that continued throughout the year. But certain things like events and certain unique products that you couldn't get anywhere, people were definitely willing to spend on. And so I think that was key message: is value but uniqueness, and people still were willing to spend. And then we kind of saw that continue through the holidays here. What we're showing on this slide is visitation trends for certain categories that generally you see during the holidays, so clothing, department stores, shopping centers, superstores. Right around the big events. So Black Friday and the Christmas holiday itself, really big peaks, and certainly bigger peaks than what we had seen from the previous years too. So I think that's kind of the other message here too, is that again, we continue to have a very event-driven consumer. I think that's going to continue in 24. People are willing to spend. It's the shoulder periods that people are just still taking a pause. It'll be interesting to see how this develops, because do we still have enough discretionary spending? Is there enough disposable income to really drive and keep us out of recession? That's a big unknown at this point too. There still are spending headwinds, although we've seen abatement in food at home inflation. That's certainly helping consumers. But it'll be interesting to see how it kind of develops into 24 here.
I think you bring up something really interesting though, RJ, is that we are hearing from, whether it is, the quick service restaurants, or it is, let's say, CPGs, right? They're all talking about walking back prices, which I have to say, I don't think in my many years as an analyst, I've heard, especially not kind of like en masse.
No.
So if anything, we will certainly see less inflation this year at this point, and we could even see, disinflation or even deflation, right? In terms of how this plays out, which, when the consumer's going to the grocery store, 2.1 times a week, and they start to see prices kind of, pull back, that does certainly elicit a different feeling in terms of how they feel about their situation, which I think is positive. Can you, if you think about from the holidays, right? Because typically there is this lull after Black Friday, and that's absolutely not what we saw this year. What's your feeling in terms of what happened? Because this is a very different traffic pattern than in years past.
It is. And I think a lot of it was deal driven. I think that consumers, we talked about value. It wasn't the only factor in 23. Certainly there were other things going on. We talked about, beauty and self-care and some of the other categories that did well. But at the end of the day too, value did work very well, and particularly low price points. And so it was kind of a return of the doorbuster, in 23. We did see a lot of the large chains. So whether it be Best Buy, whether it be Target, whether it be Walmart, do really well on the deal front. And I think that was partially what we saw. And this slide here too shows the traffic that we saw for Best Buy and Target and Walmart heading into the holiday. Best Buy had a tremendous Black Friday. A lot of that was kind of the doorbuster promotions. And so I think that's what we saw, in past years. Maybe it didn't have quite the same inventory level. Some of the retailers didn't have the same inventory to do that. Maybe they had pulled it forward to kind of start, earlier than later. And I think this year, a lot of these retailers kind of responded. Maybe there's a little bit of fatigue doing, Black Friday promotions in October. Maybe getting a little bit closer to the holiday, seeing some of the things we had seen throughout the year there. So I think that's kind of something we saw, deal promotion, and we start to see it, and tying it back to your comments about grocery. To your point, you almost never see lower prices in grocery. That typically doesn't happen, even if inflation is pretty benign. You typically don't see that happen. And so, but I think what we're seeing now is, instead of just kind of the percentage discount, people are really fixated on lower prices. I think we've seen the idea that prices just keep going up, and there's a sticker shock. And so instead of kind of a half price or 20% off, people are really fixated on lower price points. And I think that's some of what we saw on the holiday, and we're also starting to see early in 24. January 24 was tough to read just because there were so many weather events across the country. Tough to get a good read. But if we look in February so far, it has been interesting that grocery traffic is starting to claw back. Value grocery is still doing a little bit better than conventional grocery. But I think the idea that grocery is doing well, and it's certainly at the expense of restaurants where that food away from home inflation is still an issue that I think a lot of restaurant chains are going to have to come over. But I think that's a key point thing right now looking at it. Consumers are really looking at the actual price, not just the overall discount. And I think that could be a major trend that follows as we.
And I think price per unit as well, I think is also, right, which makes sense in terms of why the clubs have been so strong. Because I think that, going back to, I remember a CEO of a large retailer was saying, and hey, right, you're pushing your cart by, right? Kind of like doing 40% off math in your head is not always the easiest, especially if it's like 84 cents or $1.84.
So, kind of taking the next.
And I think that is why the like per unit cost is something that people are really focusing on right now.
I agree with that too. It's a perfect segue to kind of talk about warehouse clubs. And I know you and I were talking about this before the webinar today. But this is another one, another category, not a surprise here too. I mean, warehouse clubs have done very well. It's always exceptional merchandising teams, both Costco, Sam's, and BJ's as well. Do a very good job on that front. It's interesting too if we kind of look at at a demographic level, kind of the waterfall effect that we saw in 23. Lower income consumers, we generally saw trade away from Walmart, Target down to dollar stores and value grocery like Aldi or Trader Joe's. That middle income consumer is still looking for value too, still being hurt on kind of the inflation front, and definitely found the club channel as kind of the key destination. So we saw a lot of growth there too. What's interesting about club too is that we saw a lot of the markets where people have moved to, so a lot of migration, and this is a perfect segue to this slide too. A lot of markets where we saw population growth, and so if you look at the absolute numbers, markets like Arizona, Texas, most of the key metros there, Central Florida, as well as Carolinas, we saw a lot of growth, and that's generally where we saw club channel outperform. They also saw a lot of younger audience, new homeowners in those areas generally do very well. We also saw some things in the kind of upper Midwest, or kind of the Montana, Idaho, where you're working off a lower base, but a lot of population growth. Some areas there where some of these retailers did very well. So I think if anything too, I mean, kind of looking at the migration where people have moved to, that's something that's really key to this environment. I think it's somewhat stating the obvious, but at the same time too, that it's really important because no matter what trade area you live in, whether it's south, west, northeast, that trade area you live in, or you're opening a store in an operating store, that has changed over the last 5 years. Maybe you've seen migration away from major cities out to suburbs or rural. We've seen certain markets lose population, New York, San Francisco, Chicago. Certain markets pick it up. But that's a conversation we're having a lot of retailers right now is, hey, I thought I knew my market. Why am I not doing as well? Or why am I doing a lot better than I expected to? And a lot of times it comes down to migration and not just how many people move there, but the composition of who's moving there as well.
So we actually have an overwhelming number of questions, but I want to address a few of them that are relevant to what we've talked about. So we had two slides kind of comparing Q4 to full year 23.
Yeah.
And so Mike asked us, it looks like Q4 was quite a bit worse than the full year. Thoughts on that?
It was certainly October was the weakest month that we saw from a visitation standpoint for retailers last year. Some of that I think was just inflation fatigue. Some of that was just not enough kind of promotions and maybe a little too early on the Black Friday. Certainly Temu and some of the other online platforms that really started to get more aggressive in advertising played a part in that as well. And so I think that was where we saw the biggest drag was October. November was slow to start the first half, but did pick up towards the end of the month, particularly around Black Friday. December was weak the first half, but then we started to see a pickup as we got through the holiday. But generally speaking, if we look kind of overall, fourth quarter we did see a slowing momentum. And honestly, to start 24, we've seen a bit of continuation. I mentioned weather was a factor in January 24, so that has certainly played a fact. February has improved. We've seen improvements from January's lows, but really kind of puts us back on the trend line that we saw, kind of as we left the year and kind of headed into the year. So we're seeing still declines across most retail categories. Consumers kind of fixated on value or events, kind of driven by that. Valentine's Day, we did see some strength, although some markets, we did see another round of weather play into that. But that's kind of where we stand if we look at kind of trends as we kind of head into the year. But you're correct, fourth quarter was weaker, largely because of October and then the non-event periods.
And then Jason asked, how are we accounting for measuring the holiday season now that it is more elongated?
It's something, we keep a look at it both on a year-over-year basis, but also year-over-4-year basis as well. We can go back to 2017 with our data. And it's really interesting to look at kind of, the visitation trends to, superstores and, kind of the key holiday merchants heading into, kind of either October, November. And, we had seen, the pickup in absolute visits. So obviously resulting in year-over-year trends. We did start to see a little bit of that growth rate moderate last year and, right around the holiday periods though. So I think that's one of the things we're looking back, just kind of looking at the progression, kind of, over the last 6 years of data that we have and kind of to better understand behavior around the different promotional periods there.
Perfect. I'll save some of the other questions as we go through, but that was great. Thanks.
Yeah. So kind of just where we start here, I wanted to take a look at some of the regional trends that we're seeing across the board. And what's interesting about this is kind of, looking at dollar and discount stores, where are we seeing success here? And one of the things that I think is really interesting is if I were to overlay a map and not only where people have moved, but, kind of the change in household income by market, it would lay out pretty well with this chart. Not perfect, but it would lay out pretty well with this. So the markets where we've seen, kind of the composition change, maybe it's either lower income individuals moving into these markets or higher household income individuals moving away from these markets. It generally lines up pretty well with this. So we do see kind of the Midwest and kind of those states do very well. Maybe a surprise that we don't see some of the southern markets do as well, especially with the population growth we've seen there. But generally speaking, that's where a lot of the household income growth has gone. So the Floridas of the world, the Carolinas, those are the markets where we've actually seen a lot of household income, either from the Northeast or either the West Coast. A lot of people have been moving those areas, and I think that's what's helping. Maybe it's a little bit weaker environment for discount and dollar stores in that too. This is also some of those markets too. There's increased competition, so a lot of growth plans have been centered around the South and Southeast, and I think that's going to be a major theme that we see this year. More and more people looking at these markets, but again, the idea that you have to understand who's in these markets. I think a lot of retailers have been surprised that, because of the competition, because of other factors, why is this competing? Why am I doing weak in these markets? So this is another thing. So.
As you look at this, it's interesting in terms of, are the markets where you would expect strength and weakness the ones that you're actually seeing?
It's interesting too. Some of the markets that we see and what we're showing here too, TJ Maxx and Marshalls are, part of the same group, but it's kind of interesting to kind of see the different, different areas that are doing well. The markets for these guys, I expect to see again some of the markets kind of in the Midwest where we have seen household income maybe go down. Not everywhere, but we've seen some kind of in the Pacific Northwest being another area too. Texas actually is one outlier that we talked about kind of where people have grown. I would say Florida and the Carolinas are kind of the key areas where we've seen household income growth. Texas has surprised a lot of people too because they you see the numbers. Dallas has picked up almost 250,000 people, a permanent population. And other markets there too. But what's interesting too is it's actually generally a lower income consumer in there, and sometimes an older population too. So some of the markets where we're seeing success. TJX has done well, and I think in Texas, and I think that's part of it there too, where you don't see Florida and Carolinas on this as well. So I think that kind of plays into the idea again, just understanding who's coming in, and it really does. The more questions I get from our customers and work with a lot of the large retailers in the U.S., it's amazing how many times you can go back and look at the migration data and figure out what's going on.
No, that's really interesting. And I think that we've seen it even in terms of like CPGs, right? Going back to this migration, right? As people's food tastes have changed and moved, right? I think that a lot of the grocers have even been surprised at the degree of difference and changes that they're seeing. So it makes a lot of sense.
Yeah, we'll get into a little bit later here, but one of the other kind of sub themes that we've looked at in 23 is the idea of personalization and really understanding what your local audience is. But if we've seen so much change in that local market, then you really have to revisit what brands are on the shelf in those cases.
One question that's related to this slide is home goods included in the Marshalls numbers or the TJ numbers, or is that just separate?
Just separate, and we'll cover home goods in a little bit too, but that's been a really interesting story to look at too. Not just because of other competitors of theirs exiting the market, but we look at like to look at things at, kind of the major category level. But home furnishing, there was a lot of really interesting things kind of underneath kind of the banner headline. A lot of differences between housewares, mattresses, furniture. We'll get into that as well, but this just includes both TJ Maxx and Marshalls. We're not including home goods in this data.
Thanks.
So, kind of continuing the trend here too, I wanted to look at, superstores by state too, kind of give a regional flavor here too. And again, kind of the markets where we've seen, maybe a little more weak, for a Walmart, Florida and Illinois. One of the things that we see here, Florida was a market where we saw a lot of household income growth. So that I think partially explains it. Illinois is really more of a factor of Walmart closing stores in the Chicago market. So again, you see the data, but usually there's a story behind every metric here. Texas, I think, has actually increased competition there too. There's a lot more competition in the Texas market that we're seeing. Whereas, Target, generally speaking, some of the markets are there. And again, these are not comparable numbers. This is both absolute. Includes both new store unit openings as well as visit per location numbers. So I think a lot of the growth you see on the Target numbers are really new openings in those markets as well. But again, just kind of looking at, kind of the different trends that are out there. And again, I think that the key here is that really each one of these states, there's something different going on, driving the different trends that we're seeing there too. And again, the idea of understanding what's going on in a local market has really become central, especially with all the data that's out there, both Placer and other data providers. There's a lot of ways as you as a retailer, or you as an investor in particular retailers can get behind these trends and better understand the different trends that are going on at the market, at the store level even. So I think that's kind of the key message here.
I mean, I think what's interesting is that, right, Texas and Florida have very strong, if you will, regional grocery.
Yeah.
And, so does New Jersey, actually. So it is interesting how that kind of lines up in terms of degree of difference in visits. And I understand store openings are a part of this as well. But that does seem to be a common theme, at least in some of these markets where we see some of the greater differences between Walmart and Target.
You're absolutely right. You're absolutely right too. I mean, if you look at kind of the success stories in grocery last year, Trader Joe's, no secret there. They had a really good year. Aldi as well, kind of with a value positioning. But then if you go kind of the next layer below that, it really is the HEBs in Texas. It's the Publix in Florida. So some of the stories there, I think regional grocery still is something that a lot of people think, and it just really underscores the importance of having localized merchandising in a lot of cases. I mean, both HEB and Publix do a really good job bringing in a mix of national and local, merchandise. And I think that's part of the story as well.
No, and I think their store managers have quite a bit of leeway. It's interesting as well. We've gotten to know quite a few of the Costco club managers. And I mean, first of all, like the volumes, I mean, they're running small businesses basically, but they also, get to be quite involved. And, if you think about if you're carrying 3,500 SKUs and you get to kind of change even 5% of them out in the market, right? That's really felt fairly significantly.
It is.
So that's, I think, also I personally believe that's one of the reasons that the clubs have been doing so well, is that really the localized. And then, right, also if you're a local business and they're supporting you, right, you're going to tell all of your friends in terms, so it's self-fulfilling.
I think you're right too, and maybe that hasn't got enough credit. I mean, everyone just kind of assumes, hey, clubs do a really good job, and it's really important how difficult that is, because for the success stories we just highlighted, Trader Joe's, Aldi, obviously Aldi being more private label, but and the clubs, I mean, there's stories of regional and national grocers that don't do that well, and it's really hard to get it right, and it's hard to do it quickly too. That's the other thing, is to make these changes quickly and kind of address what consumers are doing. That is a hard thing to do, and I think that you're right, Costco and Sam's Club, and we're seeing in the data too. I mean, they've really done a good job adjusting to changes in their markets. So I totally agree with you on that. So I thought we'd spend just some time here too to kind of go through some of the strategies and different things we're seeing across the board, and kind of tie together a lot of the things we talked about here, kind of from a thematic standpoint, some of the brands and the different strategies that we're seeing. And I want to take a step back, kind of look at things at the shopping mall. level as well here on the next slide. Mixed use has been something that's been talked about a lot, but I think finally last year we're starting to see some of the numbers behind some of those shopping centers, and the developers who really changed the tenant mix and added more residential, more other commercial businesses to their malls, and changed it really to mixed use. I think last year was really the point where we're seeing a lot of growth because of that. And just an example in Cary, North Carolina, just some of the things we're seeing there, and Phoenix, Arizona. In terms of not only visitation trends, we are seeing in a lot of cases these malls that have adopted fixed use strategies, visit frequency is a lot higher for their properties than nearby properties. For their tenants, those tenants are seeing a lot higher visits than the same brand stores in the area as well. Dwell time is generally up, although there is a balance. Sometimes dwell time may not be as up, but maybe visit frequency. Maybe people are coming more often, but shorter visits. But there certainly is a positive either dwell time or visit frequency for these type of locations as well. So seeing a lot of success stories from mixed use, and a lot of the developers coming to us and saying the returns they're seeing are just enormous from these projects. Already starting to kind of come in on their payback periods for some of the developments that they've built in these locations. So again, the idea, just the way shopping malls and kind of the way we interact with them has completely changed. And those who were early to adopt some of these mixed use strategies are certainly seeing the benefits from it.
All right, so we have quite a few questions on this topic, so I'm going to at least jump into a few of them and keep my eye on the clock as well.
Figured we might.
Yeah, no, this is a big topic. So, banks could reduce office space needs by placing more office using jobs at the branch level. Are we seeing this in reality? And we're also getting a lot of questions around just kind of not only their office space, but also just like number of branches. We've actually done a lot of work there.
Yeah, well, I mean, as a starting point, I'll start with just kind of a return to office index. And if you haven't seen it, we do have a very robust office index where we look at visitation trends for over 1,000 office buildings in the United States. And we can look at things at a national level, and we can look at things at a category level. What we've seen is that right now we're really about 65% of where we were pre-pandemic in terms of number of visits to office. The number of visitors is closer to 80, 82%. And the delta being obviously the fact that people aren't coming in every day. Right now we continue to see Tuesday through Thursday continue to be the strongest days of the week. Although Monday's starting to come back, as a lot of offices have encouraged people to come back 4 days a week. Friday still is the day not a lot of people are going in the office right now. And we see markets like New York and Miami continue to be very strong. As markets, not surprisingly, like San Francisco and Chicago would be a bit weaker, where either it's because of migration or because the particular the key business there, like tech, continues to be largely remote for a lot of those cases too. In terms of the office or the banks themselves, I mean, we've seen consolidation there, and I think that could be interesting to see that continue. Some of that's with the regional bank weakness too. We've seen some consolidation on that front. But interesting to see. I mean, we generally have seen kind of a downward trend in terms of visits and well as visit per location. I'm not sure if that tracks with what you've seen, Deborah, but that's kind of at least what we'd seen when we've done some work on that category.
Yeah, no, absolutely. And then, the other thing that's been really interesting is there's been a whole narrative around, if you think about mixed use and residential, right? Let's say you've got 200 apartments. I mean, just the sheer numbers are not that much ultimately to make, right? Like I've had a few folks go through like the math with me. And yes, is it great I mean, I think it's great for the residents, but ultimately in terms of the, ultimately having a center be successful because you have residential is not necessarily right how the math would work out. I'm sure you guys have looked at that.
No, you're right. I think it's an important distinction. Just because you add residential does not mean your centers, it does not mean automatic success for your center. I think a lot of it comes down to the tenants too. That's actually key to making sure you got the right tenants and kind of understanding that too. I think that's almost as critical, but also there's other elements too. It's kind of the idea that as you add residential, you almost have to create a brand for that center itself. And I think that's kind of one of those things those groups have done, engagement work and kind of building a brand around a center, or kind of events and kind of making it more kind of community focused. Those are the ones where we've seen a lot of success. So I think it's interesting too. The idea that you add residents doesn't automatically lead to success. success. I mean, I think there's other elements that kind of drive that as well. It's got to be in tandem with, tenant selection. It's got to be in tandem with other things that you're doing at the center level to promote it. So I think that I generally would agree with that too, that statement.
Um, I know that kind of late 22, there had been like a whole narrative, right? And I think in some ways, some of it's played out, right? Where it was going to be more challenging than most thought to get people to kind of return to office. But the flip side of that was, right, people do want to get out of the house. Is there, I know for a while there was a whole kind of like dialogue around like we were going to see WeWorks in every mall, which we haven't.
Yeah.
But are you seeing, right, kind of space utilization in different ways as we think about, right, still a very large portion of, call them office workers who are working from home, and how is that kind of changing either how retailers are building out or planning space, and then how is that changing how the malls are thinking about how their space is used?
Yeah, I'll answer the latter part of that because we're seeing a lot of that too, and we see it most in the dining category. To be honest, I mean, I think that's been fascinating to watch as people work from home more. They have maybe more control over their schedule. The whole idea, and it was something that started from Danny Meyer, Union Square's CEO and former founder of Shake Shack. Put out a tweet last year. When did 6 o'clock become the new 8 o'clock in terms of dining time? And it's absolutely true. We looked at a number of fine dining chains, and almost across the board, if we compared 23 to 19 in terms of visitation time, we saw a lot of earlier visits and things like that. And so, I think a lot of it too is people have more control over their schedules. They're not waiting till that end of the day to take the train home and then meet their significant other and go out to a meal. Also, the fact that we've seen a lot of younger families start to migrate to cities. We've talked about migration away from big cities, but we are starting to see some younger families go in. But it's been fascinating to look at, and the idea of two kind of more entertainment focused restaurants, and not necessarily just kind of the play space, kind of the Dave and Buster's or Putt Shacks of the world. We're starting to see other kind of more experiential type, the Kura Sushis of the world, the Gen Korean barbecues, where it's a little bit more interactive dining too. Those are the concepts are working really well, and so I think that's what a lot of malls are trying to bring in right now, seeing that too, and just knowing that what worked in terms of driving traffic in the past may not be the same. And a lot of it because of the consumer dynamics and the changes in behavior. And to your point, I mean, people working from home just need to get out. I mean, do something different and have some of those local amenities, some of those experiential aspect retailers to go to, and really kind of just, if you're not going downtown, you just need that break. And so we're seeing a lot of that behavior across the board. So I think that's what, as malls start to develop, I think that's, what we talked about last slide about, tenant selection. That's going to be a key part of it.
Yeah, I love this slide. I visited Ollie's on Black Friday, and I mean, what an experience it was. I'm like, and you've got, going back to, right, you've got these experiential retailers in some ways. I mean, I would say all four of these really kind of like fall into that. I mean, so it's a great slide because I do think that, following on what you just said, I mean, experiential retail is really working, and people might not put these four retailers together as experiential, but they absolutely are. It is an experience to go.
Yeah, in a lot of ways, yeah, you're right. These wouldn't be on the top of the list if you ask somebody what is a experiential retailer. But I think you're right. I think if you look kind of too, and they kind of get all the elements of it too. Experience is more than just kind of the in store. I mean, it's a combination of factors. It's a combination of the merchandising. It's a combination of the operations. It's streamlined to get through things quickly. Am I getting something unique that I'm not getting anywhere else? Which is one of the key themes we saw, is the idea that I want to be able to get something at a reasonable price, but also something nobody else is getting. I want to make myself different, differentiated from other people. I think that's a lot of what we saw in the beauty category. So if you look at on this list, we've got Ollie's, which obviously with a liquidator model, a lot of unique merchandise in there. Home goods, similar situation, a lot of things that you can't get anywhere else. Harbor Freight, same thing, although that's usually more of a market thing, usually playing on kind of the migration away to suburban to rural markets as well. Trader Joe's, I mean, there's whole the amount of people who follow new product releases there, the idea that, it's very private label, but they do a lot of good things in terms of innovation and new product assortment there too. So I think every one of these is experiential in their own niche. But I think that's right. It's kind of a different, a lot of new leaders on that kind of new way to define experiential retail right now.
Yeah, no, I love the slide. It's a great one.
This is another one that kind of plays in that theme too, the idea of secondhand. So, Plato's Closet or Village or Savers. You've seen a lot of growth in that. And, I mean, some of that may you think, oh, well, people are looking for value and so it makes sense. But there's a lot more to it too. I mean, it certainly is kind of a younger population driving this, kind of the, 20 something crowd when we look at our demographic data. That is driving a lot of that. That's why you're seeing some of this median household income number go down. But I think that, as people want to stand out and look different, they're not looking for the same kind of mass produced apparel that we're seeing in a lot of cases. We're seeing both, kind of for this tier, for secondhand, we're seeing a lot of strength there. But even if you go up to retailers like, Free People or Anthropology, that are a little bit more idiosyncratic, a little bit more, kind of personalized or individualistic, we're seeing a lot of growth in those too. Apparel was quietly, one of those categories that did really well, particularly those that, kind of made a more differentiated, kind of not mass produced line. I think that was one of those things where we saw a lot of success last year. Kind of not, I wouldn't call it fast fashion, but certainly differentiated fashion was one of those categories that really did well. And so if we look at kind of, secondhand apparel, I mean, did well, although we did start to see some moderation in the back half of the year. But generally speaking, it's a category that continues to do well, particularly compared to pre-pandemic levels.
Yeah, and I think RJ, we had talked about that, consumers they don't want to pay more, but they do want to seek meaning in what they're buying. And so, there are certain secondhand apparel, kind of locations that, right, do have a give back component. So
Yep.
you don't know, like, not only is, let's say, the aesthetic of either vintage or secondhand something that you want from a fashion perspective, but you're saving money, so you're spending less.
Yeah. Yeah.
And you're doing something good. So to me, I actually think that going back to like the 2000s, right? People born in the year 2000 or later, right? This is actually something that very much appeals to them. And I think we'll continue to see that. I believe that some of the weakness that we're seeing in terms of visits is actually just lack of product,
I think
right?
you're right.
So,
Yeah.
I think I mentioned I serve on the board of Goodwill. I mean, right? Because there are also so many other ways that, online that consumers can ultimately, let's call it dispose of their, previously loved merchandise, right? Whether it's, kind of Poshmark, a ThredUp, or the Real or many others. What is happening is just a change in terms of where that product is sold. So I think there are many factors at play here, but I think it's something I've been following closely for many reasons, and I think it's fascinating. And and the other thing that is really interesting here is I think the brands who are starting to bring in not only to their physical stores but online, right, their previously loved product. And I just there is a beginning of a narrative here that I think is we're going to see louder, stronger, better in 24, and I think the retailers who participate are going to win.
I think you're right too. I think you're absolutely right. And something we did here as the year progressed too is just lack of inventory for some of these secondhand stores. But I think you're absolutely right. This is becoming an important part, particularly for younger demographics in terms of a consideration when making a visit to the store. So I think that's going to continue to play out as we look to the years ahead. This is one that we've been talking about just a little bit more. Who are kind of disruptors in new categories and what are they doing? And so we've been watching Foxtrot, based here in the Chicago market, just merged with Dom's market as well. And what I love about these retailers, and we talked a little bit about with Costco and the merchandising front, but they do a really good job on the local assortment. If you go into a Foxtrot in downtown Chicago, it's going to look a little bit different than what it does on the northern suburbs versus the western suburbs versus DC. They do a really good job on the local merchandising front, and I think that creates a sense of newness and excitement for consumers. What we showed is kind of the percentage of wine drinkers, kind of that psychographic that we see for that for most C stores versus the Foxtrot and the nutritionally wares. Just examples of what you can see with the data here, and that they're finding very much into kind of their target audience, and with this personalized and localized assortment. So I think that's going to be another trend that we see, particularly in those markets where maybe populations have kind of declined in urban areas too. It's really important to stand out and kind of make yourself differentiated from other ones. So, just something we're seeing, not just these players, but just a good example of the kind of the personalized and localized merchandising assortment here. I think you're on mute, Deb.
Yep, we're gonna see like the coup de grace on our last slide as it relates to retail media and everything. I mean, this has really been such a huge focus And I think we can even talk about the, some of what's happening on the M&A side, because that's all kind of like really coming to play here.
Yeah, I mean, retail media was certainly one of the more talked about topics that we at Placer had last year, and not just kind of what in-store retail media are doing, but also for a lot of those groups that this is to make a retail media network work. It really is understanding not only people coming to your stores, but also your markets itself, and so understanding how different consumer behavior in a market works is something we've seen a lot of it. I mean, what we're showing on here too is that obviously, online, online retail has been very big, a lot of growth the last 2 decades, 3 decades, really even. But even at the end of the day, people coming in the store, a lot of times the reach is still wider than what it is online. And I think they work together. I mean, I think it's got to be a comprehensive platform, both for digital media and in-store media. And certainly, we saw today with Walmart acquiring Vizio, that's going to play into their digital media strategy. But there's certainly even ways that you can leverage that at the in-store level as well. So be curious to see. I don't think retail media is going away, and I think 24 is going to be even a bigger year than ever for it. A lot of ways that a lot of the retailers are learning to better tailor the in-store experience, better deliver their message, and find better partners. I think too. I think that's going to be the key growth this year is finding the right partner to participate in my retail media network. We're still very early on in that, and it's kind of the large brands that are really participating in it. Now I think this next year is going to be, can I find local either manufacturers or vendors or retailers that I can partner with within my retail media network? I think that's going to be really the key to driving a lot of the success, and a lot of data sets out there that can help you do that.
I'm surprised. Do you have the data for Target? Because I would think that this is an area of focus for them as well.
It is. It's very much, we just, I think, put a cross section of retailers in here, but, we see the same thing with Target, pretty much the same kind of, from a proportion standpoint, in terms of the in-store visits versus the offline or online. It's kind of the same thing. Walmart have a wider reach just given, how massive it is, but generally speaking, the proportion's about the same for Target.
Yeah, I mean, I think that, to us, this ability to, monetize your IP, monetize your data, right? I mean, it's really changing in some ways what it means to be a retailer. That's why I think this is such a powerful slide. And, benefits certainly here accrue to the larger, but I think that also going back to like thinking about retail real estate, right? I think that the acquisition activity and consolidation, we're just seeing the very early stages of that as it relates to grocery.
Oh, I think so too. I mean, I think, if you're thinking about kind of the overarching theme and what's driving a lot of motivation right now, I mean, I think in a raising rate environment and an inflationary environment, it's got a lot more expensive to operate stores. And so you need to find other ways to get better utilization in your stores. And I think retail media, particularly if you see the numbers Amazon puts up for its advertising division, that can be really attractive. And I think in a lot of cases, then the next step, we've got retail media, we've got personalization, we've got store in stores, these things kind of driving some of the better returns. But I think to your point, I think we're going to start to see consolidation drive some of this as well. Can I partner or maybe a joint venture or an outright acquisition? Can I partner with another chain to really maximize the use of my retail network too? So all these different themes kind of playing in, kind of how can I get a better return on my stores right now is I think one of the things, the central overarching theme when we're talking to senior leadership right now, what are things I can do? And I think a lot of them are exploring different things like this.
All right, I'm going to throw out two questions just because I think one of them came up a few times. So for the 2023 favorite set for 2024 success slide, is this web traffic development or visits to physical stores?
Visits to physical stores. So that would be just all visits there. And each one of those companies that we highlighted, whether it's Home Goods, whether it's Ollie's, whether it's, the other ones on there, each one of those two, they were kind of unique in the fact that they did see so much strength in terms of, in-store visitations last year. So I think that's going to continue to be a big story as we look, in the year ahead too, because a lot of the themes that we talked about, the idea of the experiential retail and the, unique product assortment and getting values. I mean, that I think is going to hold in 24.
All right, so a lot of questions around the presidential election. So I'll take one that seems to summarize it the best. What kind of year should retailers expect in 2024 with it being a presidential election year with an uncertain outcome?
Yeah, it's interesting one is one we want to dig into a lot deeper ourselves. I mean, the 2020 election, obviously from a store visitation standpoint, tough to get any real meaningful takeaways from it just because it was such a unique year in retail with the pandemic. So I think that that's going to be interesting to see what plays out on that front. Honestly, I mean, I think that typically what you've seen in terms of retail sales, I mean, I guess that's the closest proxy we can look at. There's a lot of uncertainty, particularly look at the last three elections, and generally speaking, that does tend to put a little bit more pressure on overall retail spending as people kind of go in with uncertainty. And so I think if we kind of talk about where we started to head into the year, and certainly there's other factors at play, whether it be weather or other things, I think that they could lead to more uncertainty. And so if we kind of see the shoulder periods, they may be a little bit weaker than what we saw last year, whereas I think consumers will continue to spend around events. But yeah, this is one where, unfortunately, we don't have data for 2016, and the 20 data is a little bit tough to read with the pandemic. But using retail sales as a proxy, it could be a little bit more pullback, just as we kind of have this uncertainty, and people kind of want a little bit more clarity before feeling free to spend again.
No, I think it makes a lot of sense. And then the last question, like I said, there's a lot, but we'll leave it this one. Will the consumer continue to spend in 2024 despite the high level of consumer debt?
Yeah, it's an interesting one too. And honestly, we've looked at a little bit of the consumer debt side, as that's had an impact. And it really has not seen a strong correlation yet. I mean, I mentioned last year we did see strength around the event periods, but the shoulder periods being down. And if you look kind of on if we look at overall most retail categories, we're down slightly to high single digits last year. We could see that start to accumulate too. And I think it just plays in this idea of uncertainty. I mean, if I've got more debt, I'm still dealing with some impact of higher interest rates in some cases, particularly for autos and other products, other big ticket, less so in the house, although that's still higher than where we were. I think that, it's probably fair to assume that with consumer debt, we'll probably see more headwinds. And again, the idea weaker shoulder periods in between events this year, I think that could certainly play out with that where we stand with debt. I think that's been, something of an underrated headwind. Inflation gets all the headline, but, personal debt is kind of the next step beyond that if it's got more expensive to do things. Deborah, to your point, the idea of wealth effect and understanding how consumers feel, that can have a material impact if you're just burdened with that. I think that can have an impact on spending too. So, I guess if I had to sum up 24, some of the same trends that we saw: focus on value, focus on unique products, but there may be more challenges in terms of the consumer's ability to spend, whether it be debt headwinds or other things like that too. So it'll be interesting to see it play out, or the election too. That was the other point. So it'll be interesting to see how it plays out in 24 here.
Yeah, I mean, it is interesting when you think about, right, President's Day weekend is typically like bigger ticket, right? White goods and autos.
Yep.
And so it'll be interesting when the data is in what that, what that looks like kind of year on year, but also, and once again, understanding weather kind of all around. But if we look at, Super Bowl, Valentine's Day, President's Day weekend, right? If we start to look at those and see, right, some, right, kind of connective tissue between the three, and just what the kind of typical purchasing is on each of those holidays, and maybe what that alludes to as we move ahead through 24. It's going to be really interesting. Thank you, RJ. This is always like one of my favorite, kind of webinars, because we understand so much more about the consumer, what's happening in terms of foot traffic and online with RMNs. And then really it kind of sprinkles forth what we should expect in terms of spending from a capital allocation perspective, but also from a consumer's perspective. So thanks again for joining us. Always helpful, and looking forward to seeing you in person soon.
Likewise, too. It's always one of our favorites. Thank you very much.
Thanks everyone for joining. Take care. And if you have any other questions, please reach out.